Is the sell-off overblown?
I think so. I think I'm on David Kostin's page here. I think, look, you know, if you look at the ratio of, say, the NDX to the SPX or the XLK to the XLF, you see these periods where it really is underperforming. And of course, we have a broader discussion layered on top of that of, you know, how late cycle are we? What is the 210 curve spike and the 10-year yield spike, you know, sort of telling us on the broader macro theme here. But I think what's been happening here is that, you know, the buy side has been playing it safe since Q2, particularly with the stuff that has run a lot. But that safety also helps ensure further, you know, a higher probability of a rally coming out of earnings here. Obviously, earnings do have to perform here. From a top-down perspective, I don't see many reasons why they shouldn't be reasonably strong. And I'd make the further comment here that of all the sectors that we talk about in this late cycle discussion, you know, if you think about unemployment pressures, well, sure, Amazon just raised its minimum wage here, but broadly speaking, for the tech mega cap companies, they're largely less vulnerable to a lot of these late cycle risks and pressures that the market narrative seems to have been focusing on lately. You know, programming costs are not really part of that U3 discussion that the Fed and others and economists are so focused on. It's a different discussion, and I think that's going to be another reason why they're going to get bid here if we do find good earnings.
Sarah, walk us through the underlying reason that investors are selling.
So there's been a lot of reasons out there that investors have been blaming for the sell-off in tech. So whether that be the run-up in rates that we saw, or that some tech companies are more exposed to trade with China, as well as the fact that maybe this was just a momentum trade that had to get unwound. And what we also heard from David Kostin saying that valuations maybe got a bit ahead of themselves and that this was just a crowded trade. However, as David Kostin did say and point out, he said that if you look at computer and software companies, they have actually been cheaper than they've been historically. And at the same time, if you look at holdings of mutual funds, they actually right now hold less tech than the average benchmark index. So in fact, that idea of them being very overcrowded or extremely expensive just might not be the case for certain investors.
Now, Michael, you know, did this start earlier this year with Facebook, with Cambridge Analytica, with that big bad earnings report where they had, you know, $20 billion wiped off their market cap?
Well, you know, it's interesting you brought that up because I think one of the other reasons why I feel a little bit more comfortable about being overweight or long this sector is that since the Facebook scandal with Cambridge, you know, really erupted last spring, what you've seen here is a pretty much persistent bid for NDX volatility there, which means that people have been buying the dip, but they've been buying the dip with some insurance or some protection there, and that should help insulate a downside risk if some of these you know, whether it's a big earnings miss or maybe the prospect of a tail risk of government intervention starts, you know, coming more into the foreground here. I think that latter situation is a little bit more hypothetical than real right now, but obviously something you need to be wary of, particularly given how skewed the sell-side analysts are on the FANG stocks and so many of the tech names where there's a lot of buys, not a lot of sells.
Facebook actually had some 20% wiped off its market cap, which was closer to $100 billion. Sarah, is this kind of volatility here to stay, knowing that we have earnings coming up this week?
Well, I think there's no question that this week is going to be a huge week for the market as a whole and for a lot of these big cap tech names, just because we have some of those huge ones reporting. Now, I think they are expected largely to come out strong. However, if we get any misses or if we hear management caution at all, we've seen in the earnings season so far that almost any news is bad news. If you miss on one number, or if the executives do come out talking about price pressures or trade, then that could hit the stock. However, those aren't really issues that should be expected with some of these big tech companies. But if you look at VXN, which Michael was just discussing, the volatility index on the NASDAQ 100, it's risen the past 3 weeks, whereas it kind of came off a bit for the VIX last week. So we continue to see volatility in these large tech names.
So, Michael, what's your advice to investors right now, knowing that Netflix actually reported a strong quarter? This was on the back of a not so strong quarter, and that there are a few days left before we actually have this new information.
Look, I think if you have a generally positive view on risk appetite, and the broader equity market, you really need to be long tech and FANG and growth stocks. Every time we get a 210 curve spike here, you see this narrative about rotation into value, but I'm not sure you necessarily whether that argument is going to hold up this time, but it didn't hold up the last several times that happened. So I would stay with what has been working. I think it's going to continue to work. A lot of these big cap stocks are just not burdened by a lot of the late cycle vulnerabilities. The quality of their earnings growth, if volatility adjusted earnings growth over the last 5 years for these stocks has been far superior to what we've seen in other equity indices. And I don't see reasons why that superiority won't persist, at least for the next 6 to 12 months.
Now, Sarah, the point has been made that tech is relatively cheaper to what it once was, but is that a good benchmark?
I think it depends what you're looking at. What's interesting is you can almost find a valuation for everything. Some people are looking at price to earnings, some people are looking at price to book, price to sales, and people will kind of pull on what they really feed off of. So yes, relatively cheap compared to history, yeah, that would be a good benchmark to go off of, but it really depends on how you are actually evaluating the prices of these companies. And also you have to take into account their forward growth and their forward price. So you have to take all this into account when trying to figure out if this is time you really want to step in and buy.